How does profit tie into equity? Recall from the video about financial reporting elements that the profit less dividends is used to calculate retained earnings. You may also recall from the previous video about the financial reporting elements that retained earnings is part of equity. Equity equals owner's capital plus retained earnings. Remember, profit is equal to revenue minus expenses. So now we can see the relationship between revenues, expenses, and equity. When revenues increase, profit increases, retained earnings increases, and as a consequence, equity increases. What happens when expenses increase? Equity decreases. Why? Because expenses reduce profit, which will reduce retained earnings, which will reduce equity. What else affects equity? Equity is increased by owner's capital, the amount that owners invest in the business. If owner's capital increases, then equity increases. Finally, equity is decreased through dividends because when dividends increase, retained earnings decreases, which causes equity to decrease also. The interrelationship of these elements can be shown through a flowchart. We'll start with equity. It's made up of owner's capital plus retained earnings, which is made up of profit minus dividends. And profit is made up of revenue minus expenses. So let's just remind ourselves, why does an increase in expenses and dividends decrease equity? Because there is a negative sign in front of the expenses and dividends. So they both decrease retained earnings and therefore decrease equity. The sign in front of the element indicates its impact on equity. When an element has no sign in front of it, such as revenues and profit, it has an implied plus sign, which indicates that its effect on equity is positive, an increase. Revenue and owner's capital therefore both increase equity. Note that the above flowchart can also be shown as an equation. Equity equals owner's capital plus revenue minus expenses minus dividends. You can choose to use either the equation or the flowchart to solve questions. Let's check our understanding. A new business has the following financial information available at the end of the year. Revenues of $324,500, expenses of $298,400, and dividends of $7,000 were paid. In addition, at the start of the year, the owners contributed $250,000 to the business. What is the equity at the end of the year for this new business? Equity is, insert your amount. Let's use our understanding from the flowchart in order to calculate this. I'm using short forms in the formula. Let's just fill in for our knowns. Revenue, $324,500. Expenses, $298,400. Do the math. This equals profit of $26,100. Dividends, $7,000. $26,100 minus $7,000 is equal to $19,100. Owner's capital, $250,000. Add the two together. Equity is equal to $269,100. So how do assets and liability tie into equity? I'll show you that in the upcoming video.